Welcome everyone to today's RaaS Research Group Stock Take webinar, where we will dive deep into the analysis of another promising ASX-listed stock. We've had some crackers in recent weeks, and I guarantee we've found you another. Today, we're focusing our attention on Wrkr, ASX code WRK, a leading Australian reg tech company who make compliance simple for employers and their employees from hire to retire. RaaS Research Group's detailed analysis, presented by Senior Analyst John Burgess, will cover all the main themes, financial models, and potential pitfalls any investor should consider before making an investment decision. This presentation will then be followed by Wrkr's CEO Trent Lund and CFO Karen Gilmour, who will give a detailed overview of the company. Trent and Karen will also participate in a moderated Q&A session where you will be able to have the opportunity to ask questions directly to them and also to John. So submit your questions during the presentation using the Q&A function on your screen. Drop them in at any time and we'll make sure we put them to our presenters. I will be collecting those questions and putting them directly to our presenters during the Q&A segment. Thank you for joining us, and without further ado, let's get started. Please join me in welcoming RaaS Research Group Senior Analyst John Burgess. John, over to you.
Thanks, David. We'll go to the agenda slide. So, we picked up Wrkr in July 2023, so it's been a very busy 15 months. I thought we'd go back to that initiation and look at the key themes that we highlighted then and see what's changed. And which includes, I guess, the timing of some of these key sort of contract and customer movements. Have a quick look at our current estimates and current valuation, and remind people of the sensitivities that drive this valuation and estimates. So we'll move on to the So at initiation, I guess the simple message that we had was from the revenue base. I think at that time of 6 million, there was 3 step changes that we could see over a 3 or 4 year period that could take that revenue from sort of 6 million to sort of mid 20 million in revenue. They were obviously the Link, which is now MUFG. They were the Link client migrations from Link to Wrkr. There was the benefits of Payday Super, which is scheduled to begin July 2026, so FY27. So I should say, go back, that Link, depending on how many clients move across from Link over the next sort of couple of years, we identified that as something like at least a $6 to $8 million revenue uplift. Similarly, if those clients migrated and Payday Super was implemented, and we'll talk about that, I'm sure the company will too, we had some pretty conservative assumptions on how many more transactions Payday Super would result in. Only 2 times, it could be up to 4 or 5, but that was another 6 or 8 million opportunity. And then the company's major client on their platform, Art, they had just acquired QSuper, and they were merging the two, and bringing those QSuper clients onto the platform was another $2 to $3 million by our estimate. So, from 6 million, we had sort of a couple of 8 million and a 3 million jump to get to that sort of mid 20 million revenue, and that was basically the key. There were also some new product developments going on. Wrkr Ready was one of them in the very early stages. Anyhow, with all that sort of assumptions, we initiated with a valuation of 8 cents, and the share price at the time was 2 cents. And in 2023, we had a break-even EBITDA forecast for 2024. So if we move to the next slide, David, we can see what's actually changed since. And there's been a lot going on. Obviously, first of all, Link was acquired by Mitsubishi Financial Group, so that's quite a big change, and quite a big risk when you've got a key client under new ownership. And that seems to be navigated very well. The trials with clients of now MUFG, from my understanding, and certainly the company can go into in a bit more detail, The scope has increased, so that there's been a lot more work in sort of just going from just super clearing to a whole bunch of other products, including payroll, in terms of the trials with these super clients like REST, which is the first client announced. And so the scope's increased. In this 15 months, they've moved into Hong Kong. So that was something we hadn't even considered 15 months ago. And they've actually moved in and obviously received milestone payments for that and had to develop product. The Q Super migration hasn't happened yet. There's still a contract in place with the legacy provider there, and so we've adjusted our expectations for that migration, which we'll talk about later. There's been a 25% increase in the price that Wrkr receives from Art per user on the platform. So that was certainly new news in the last 6 months. And one thing I've obviously missed here is that there's been a pretty substantial capital raise of about 9 million and conversion of convertible notes. So there's a lot going on. Makes modelling difficult. But with all this change and delays / increase in scope, the company delivered $500,000 in EBITDA in FY24 versus our break even when we started. So it's a very commendable result with all those things going on, trying to control the cost base, invest in product development, and achieve a break even EBITDA. So it's been a lot of change, but well managed. If we go to the next slide. So where we sit today is that certainly our numbers when we started, our 25 numbers have come down from our initiation because of the timing of these client integrations. And again, these are still estimates, subject to change. But the first trial with the MUFG group begins in October, finishes in December, and so post that trial, we would expect the beginning of the migration of some REST or all REST clients to the Wrkr Pay platform, and so we now assume that to begin in the second half of FY25, and there's something like 1.4 million potential users. Hostpass, which is sort of the second large one that's been identified as an MUFG client. We now forecast that should be H1 26. So we think that once the first client migrates and the trial's been successful, it certainly makes the second migration easier, should make it easier and quicker. So we estimate that begins first half 26. And there's a few other small funds that MUFG have that are also likely to migrate over this period. And there's also other users outside of the super funds that can also potentially new customers. So each of these customers represents up to $8 per annum in ARPU. So when you're looking at something like 2.2 to 3 million clients at $8, again, it sort of ties in with our initial thesis that there's upwards of sort of 15 to 20 million in new revenues possible over the next 3 years. If we go to the next slide. So in terms of our Wrkr's EBITDA history and our forecasts, you can see they've moved from loss to a small profit in 24. We forecast continuation of that profit in growth in 25, and then a real uptick in 26 as the MUFG clients migrate, and in 27 it's further migration of clients plus the payday super regulations that are scheduled to come in. Now, the difficulty with these numbers, it looks like a hockey stick, and I'm always sort of reluctant to have that sort of hockey stick style earnings thing. But you can certainly see how the revenues flow in, and there's not a lot of costs associated with that new revenue, but there are some costs obviously at the operating line that we've tried to forecast in. Whether we've captured it all, whether we've forecast too much, it's difficult to know. So obviously we'll keep a focus on the cost line, and the company's obviously trying to manage that revenue with the cost. So as the revenue grows, they're able to invest a little bit more in cost. And there's a whole bunch of new products that are ideally, I suspect, that they'd want to spend more money on to take advantage of the client migration and the number of clients potentially coming across. But anyhow, that's where our earnings sit. You can see how they get there, but they are prone to some cost, estimates changes over and above what we've got forecast currently. If we go to the next slide, David. I think one thing that's always useful to me, I like to see tech companies invest in their product, both existing and potential new products. And Wrkr has been spending a lot of money, in relative terms, over the last 12 months developing new products, entering Hong Kong. And so it's good to see that they are, in terms of the compliance peers that we select at the smaller end of the market, they're up there in the sort of number 2 or 3 in terms of the R&D spend relative to FY24 revenues. And so, again, it's a good sign, and it just shows you that there is a lot of investment going on in product for future revenue growth. They have a very strong balance sheet post that raise relative to their market cap, relative to their peers, which is another good thing. But at the moment, I guess the only question you could highlight is that their EV to ARR from our calculations are at the top end of the peers. But obviously, I think the market's appreciate this is on FY24, and the market is appreciating that, with the revenue potentials in 25, 26, 27, it's not necessarily the most relevant metric for 24. If we go to the next slide. So in terms of valuation, obviously earnings are still very early on in the piece. I wouldn't want to do a multiple earnings multiple revenues relative to where they think they can get to. They're probably still too low, so we wouldn't do a revenue multiple. So we come back to the old DCF. So our DCF valuation as it stands is 7.8 cents. I think the stock today is sort of low 5s, 5.1, 5.2. So we still see a lot of upside. We're still using a WRkr 12.5, which includes a beta of 1.3. So we're still trying to price in some risk of these contracts actually coming across and generating revenue. And we only have a 5% medium-term growth rate, which is sort of from estimates from 2029 onwards. So I don't think there's a lot of we haven't got a lot of growth forecast. We also don't have very little, if anything, from any opportunities that the company may come across in payroll to complete the super package and actually add payroll and all the benefits that come with that. So we're really just focused on client migration from 2 to 3 MUFG customers, the ART merger of QSuper and the same day payday super coming in 2027. So that's what really gets us to our valuation as we sit today. Next slide, David. In terms of the sensitivities to both the valuation and our forecasts, the clear number one sensitivity is the migration of the likes of Rest and Hostplus to Wrkr Pay. If those customers don't move across, you don't get the benefits of the interest rates, the flow earnings on the holdings. You don't get the benefits of the transactions. You don't get the benefits of payday super and the sort of potential to double those transactions in FY27. So that's the number one risk to the numbers by far. Much less of a risk is the client migration of ART to or QSuper as part of ART to the platform. We're only talking maybe $2 or $3 million in revenue opportunity there by our estimates, whereas the Wrkr Pay, with MUFG is closer to an $8 million opportunity at least. The level of interest rates has some impact. Wrkr do make money from the float income of the super holdings that they hold in trust for 2 or 3 days. So the cash rate, we've got the cash rate coming down in our numbers by 50 bips. So we have tried to forecast some rate cuts, not being too reliant on rates staying where they are. But it's certainly, if they get back to, zero, then you'll lose the float income. And then obviously there's product development still being, onboarding of super payments clients and so on, still in its infancy, and we do have some revenue benefits from these products going forward. So there's some risk there. And I guess on the other side, what we don't have in our numbers is really the whole payroll picture. As I said, we're really just focusing on the clearing of the super and the opportunities of clients coming onto the platform. We really haven't got anything for payroll going forward. So I think, David, that's the end of the summary of our current thinking on Wrkr.
Thanks very much for that. A great overview, John, and I think really sets the scene for the rest of the presentation. Now, remember, a copy of the recent on Wrkr can be found on the RaaS Research Group website. So if you want to go and do your own deep dive, jump on the website, download the research and check it out. Now it's time to hear directly from Wrkr's CEO, Trent Lund, and CFO, Karen Gilmour. Please join me in welcoming both Trent and Karen, who will go through a presentation of the Wrkr business and then at the end be available to answer any questions. Trent, Karen, over to you.
Wonderful. Thanks very much, David. And thank you, John, for comprehensive analysis of our business, of course. So we'll try and cover off a couple of those areas, particularly around payroll, which aren't covered as much in that set of numbers. So I thought, as a quick, if we could just jump to the next slide, and I'll just to refresh for everyone. So where do these numbers come from? Well, it's worth starting with what is our purpose? What is Wrkr about? And we really have somewhat of a simple task or simple purpose, but a complex task is maybe the way to think about it. That's to help Australian businesses and workers be ready to start work. So that's ensuring that your staff are compliant, ensuring your staff are set up on their super, are set up with their identity and have met their various compliance obligations. Make sure that pay and super specifically as a priority is correct and paid on a timely basis, and then connect employees to the appropriate benefits by taking advantage of the insight we have of both pre and post-tax information for employees. And the way we do it is just by taking the complex compliance moments and making them simple, and actually really long-term is making compliance valuable to employees. So do it once, do it well, and have portability of that information. But our mission really starts in the super industry, and that's around digitising, transforming the pay and super processing to straight-through processing, because they're the most ubiquitous moments. So if we jump to the next slide, I'll just jump into a little bit of summary detail. I think John covered this well. Look, a good way to think about our business is while we have quite a broad revenue mix across our products, onboarding, pay and super processing, compliance report lodgements, and license credential checks, our revenue mix is predominantly geared towards SaaS user license and transaction fees. We do, as a payment processor, have float interest, and we have some legacy contracts, particularly ART, which is built around license fees, support maintenance, and some innovation services that go on that platform. But interesting for our business today, a new brand, although steeped in some history, been actively involved in the standards in this industry across a variety of brands since early 2009, and on that basis, where we touch today, we touch TFNs, so tax file numbers, about 2.9 million unique Australians across our various footprint of our technology. So if we can jump to the next slide, I just frame the problem for you that we seek to solve. And most people are oblivious to the fact that it is a major problem or challenge in Australia around compliance, unless you've been an employer and you've had to go through the process. And really the problem is twofold. It's hiring staff and paying your staff. Both of those two, what's seemingly simple moments, actually require, on the most part, software to solve and help with processing. But actually, behind the scenes, there are very complex steps that actually require quite unique licenses to complete those steps, and so they need to be outsourced. Even payrolls outsource the steps around super payment, for example. So if I just touch on a couple, identity verification or right to work checks. Visa checks in Australia require a connection to Vivo, the federal government. The infrastructure required to do that digitally and meet their security standards is complex. And that really goes across the board. Across on the right-hand side in payment processing, specifically when we talk about super, which is one of the more complex and more regulated payment moments in Australia, there is a need for complex licenses such as gateway licenses, clearinghouse, financial services licenses for non-cash payments, and particular digital capabilities to support the ATO's requirements under single touch payroll and rollovers. So what this really exposes is that simple role of hiring and paying an employee is actually the top of the iceberg. What sits beneath the water is a lot of complexity and technology, infrastructure and licenses, and that really is where Wrkr plays. If we jump to the next slide, and then we can get into the meat and potatoes of the business. But who really has the problem today? Well, actually, the biggest challenge is for super funds, as super funds help their employer clients. And if I take an example, companies like REST have over 1.4 million members that are in contribution phase. So that is employees of their employer customers who are paying into their super fund today. So super funds are the biggest concentration points of the need for these services. And in particular, they take an active interest and in fact pay and provide solutions to employers to help ensure that they do pay on time and accurately for super, for example. Payroll providers being the next in Australia, and this is twofold. One, the regulations are quite complex. You need to be a supplier of a large volume to do it effectively. There are only circa 6 active licensed operators working in the full end-to-end super processing through to payment movement. And so payroll providers need to outsource the super contribution to providers such as Wrkr. And this continues right up through the spectrum. And you'd ask why? Well, it's actually because scale is important, but two, many software platforms are actually developed internationally and do not have a natural focus on some of the nuance of the Australian regulation. So that's why there's an opportunity for a company like Wrkr. So if we jump to the next, and I'll just explain, in simple terms. So what is it we specialise in doing? And that's really providing a digital solution that allows can be licensed by the super funds, by payrolls, or by employers directly, and that is for the processing, so onboarding of employees, managing those unique compliance moments. Even if they have existing HR software, we integrate to that software to allow these moments to be achieved correctly. And then, of course, the payment processing, where Wrkr specialises in the movement of money, both wages and also disbursements, union fees, other fees, but specifically superannuation fees being moved into the super funds with all of the appropriate notifications to the ATO and the various regulatory bodies. That's really our specialty. We focus on trying to make those complex steps really simple in one touch. If we can just jump to the next. And we do it in really two ways that stand out, and this is what matters. One, we really seek to provide a one-stop shop for these moments, and that is it's hard enough for employers to meet the compliance requirements, but to have multiple parties and systems providing those makes it very difficult for them to have any level of visibility of their compliance. And the compliance requirements are not only onerous and complex, but they actually come with hefty fines and reputational risk. So setting up a one-stop shop approach for companies. And number two, we've specialised in a mobile experience that lets the employee participate in their compliance moments. It's your data, so you should be participating and providing it. And we have a very simple approach, which is you should be able to do it with your thumb on the bus on the way into your job. There's no need to ask for the same data several times, and we have an attestation model where we go back. If you give us your driver's license, we go and verify that's a true and correct piece of information, and then we can rely upon it for each of the next stages. So that's sort of a key to our business. So what have we really done? And there was discussion around MUFG in some detail. So if we jump to the next slide, Wrkr invested over the last couple of years alongside MUFG Retirement Solutions, back when they were so as Link Group and now as MUFG Retirement Solutions. It was a substantive co-investment in a couple of things. Taking the Wrkr product and white labelling it so that it could be branded by their fund clients as a solution to take out to their existing employer-based customers. So that was the first part. We integrated that into their administration platform, which creates great straight-through processing, but also cleans the data of individuals and their super payments. Full integration into their support model and contact centres, and also the ability to provide additional services out to those employers in partnership with both Wrkr and MUFG. And this very much is a game-changing approach for us. And I think if we jump to the next slide, this is really what, thank you, David, what John was referring to, and that is, so why MUFG, why such a large investment between us? MUFG represents some of the largest super funds in Australia. In fact, some of the more successful super funds, so Australian Super, Rest Super, Host Plus, CBUS, still currently with Hester as a client, and also through their other platforms, some circa another 600,000 members through around 6 to 7 smaller funds. And it's about 7 million contributing members, people in the accumulation phase of their super, out of a total employee market in Australia. Our best analysis is about 15 million unique employees. They share about 19 million jobs, so there are some working harder than others. But of those 15 million employees, it's nearly half. And so we felt that level of co-investment was the right way to reach the largest base of customers, to then provide our broader services. So building on the bottom of the pyramid around super contributions, moving into payroll support, and then going further into a range of compliance moments that we already support, from contract signing, digital signatures, APRA medical license accreditation checks, working with children's checks, visa checks, you name it. So that's really the why and what's unique. If we kind of jump ahead one slide, thanks, David. This is really for us. It's a large, very large market, but it is also a market for us that is additive. So the superannuation contributions that we process are unique. To extend and add payroll and pay processing they are unique transactions. So that's another market of growth opportunity for us. Disbursements again, and then each of those compliance moments that I mentioned are again a growth in that space. And so it's when we look at the market, we see both the Australian market to be quite large for us. We already process today directly about 500,000 users, indirectly through our software services about 2.4 million users. But we can see the opportunity through this offering collectively with MUFG Retirement Solutions really gives the chance for our business to be providing those services nearer to a total market. We believe that we can achieve between 6 to 7 million active users. So that's pretty important. Our ARPU on our direct users today sits around $8 per customer, and that excludes the onboarding services, which are quite unique and have a much higher margin of opportunity. Obviously, the partnership with MUFG has the opportunity to extend ahead of schedule. As John mentioned, we've already partnered in Hong Kong and are currently in the process of implementing our platform in partnership in Hong Kong for managing contributions for their pension-based market. So that's really the key. I'll probably touch on just one other element, and that is why the funds and why do they like our solution? Well, we're the first to really bring those small compliance transaction moments together with onboarding to ensure that moment where someone starts in a company for the first time, or indeed already has a super and moves to another company, that we don't add multiple accounts for that individual, that we ensure that as per the new rules and laws around payday super, that individual is stapled to their existing super fund to allow it to continue to grow. And the industry funds in particular, same names I mentioned before, that's something they're very focused on, we know. So maybe if I jump for a second for Karen to share a little bit on our financial journey, and then we can finish just with the industry trend.
Thanks, Trent. So I won't spend too long. We've had a good rundown from John on forecasts moving forward and where we see the opportunities. I just wanted to touch on our results from FY24 briefly. You can see on the slide in front of you, we've had 4 years of over 40% revenue growth, which is a fantastic result. In FY24, we had a 46% growth in revenue. That was really driven by the MUFG market services opportunity, building, developing and implementing that clearinghouse and working with REST to do the integration and to get that live. We've seen the revenues come in from that of 2.5 million in FY24, and we'll continue to see additional revenues in FY25. Also, as part of that growth, we have our SMSF hub and the consistent remaining interest on the float income from our clearinghouse. We also have our Click Super clearinghouse, which is, the product that we originally started with in this company. And so that sees us have continual revenues that are really consistent and that we can rely upon year after year with very minimal turnover of our customer base. We were really pleased to have an EBITDA positive result at the end of this financial year of 500,000. That's the first time since the company was listed that we achieved that result. And so that was great to see. That also meant we had an operating positive cash flow position. We also had, as John mentioned, significant investment into our platform. So that's really setting us up for these opportunities moving forward with the MUFG market services and really capturing that opportunity as we see payday super reforms starting, which I know Trent will talk about and explain a little bit more in a minute.
It's probably just worth noting too, the cash at bank obviously has changed significantly since the capital raise itself. We ran a capital raise that was certainly had significant interest. We capped the raise at 6.6 million and did an SPP side by side. with that. And in that SPP, again, while there was over 3 million in offers, we had that capped and took 1.2 million in addition. So 6.6 and 1.2 million in funds raised to underpin the growth around the expected opportunities with MUFG. So just to clarify that, I also got in trouble because I used the outdated slide and threw Karen under the bus there. Sorry, Karen.
That's okay. I was going to go into that kind of capital raise a little bit more. So those funds we're really looking to increase our speed to market and bringing on additional funds onto the Wrkr platform, as well as other third-party opportunities, including integrations with payrolls and payroll service providers, administrators. So those integration pieces are really important in our next 12 months, and similar to what we've already announced around the KPMG Workday solution offering. So we are looking forward to seeing that roll out over the next 12 months as well. I think on that, I'll pass back to Trent and we can field any questions around financials in the Q&A.
Right. If you throw to the next slide, just quickly, David. We actually will jump ahead. I think those figures have been well. I just want to touch on regulatory tailwinds. The payday super announcement has come out, and it is significant for our industry, and that was one of the areas that John put in as one of the sensitivities to give people an understanding. Obviously, if you're over 3,000 employees, you must pay your super monthly. Other than that, it's at your discretion, but must be paid quarterly. Today, there are about 160 million super events. There are pay or wages being paid is about 500 million. So what that tells you is we have the super industry with payday super will now move from 160 million events up to 500 million events. So it's a fairly substantive growth, circa 2.5, 3 times growth. There will be some users and employers who pay quarterly today, who pay weekly, who therefore will move to 52 pay events. It will have a substantive shift on the transaction volumes. Obviously, we expect to be a beneficiary of that change. We still do an enormous amount of work to make those transactions go straight through and process them. However, as a return on investment for our innovation, R&D, and overall product management, it is a really big important growth cycle for our business. But it's just worth touching on that. The regulatory tailwinds, let's be honest, I don't know anyone who's seen compliance shrink or become more simple on its own. So the reality is, for a business like ours, we kind of buck most of the trends in that we're not seasonal. Compliance is always there. Compliance is becoming more difficult for employers, and in fact, the compliance moments that are required are increasing. And actually, with the shift towards the digital economy, they have shifted upwards, not backwards. So that's really probably the most important element of the industry trends. But I'm sure the Q&A will jump into that a little. Thanks, David.
Thanks, Trent. Thanks, Karen. Great presentation and a really good deep dive into the Wrkr business. A stack of questions, so we might just jump straight into it. We will welcome John back on as well. Question here, can you discuss Super Choice, who I assume is a competitor, and their differences and similarities?
Look, I can. I'll try and keep it brief. We don't like to talk to competitors at a strategy level. Key differences between our organisations are we are very focused on the onboarding moment and had invested heavily in that. Started back nearly 6 years ago. So have a a very mature product in that space. So at one level, that's our core difference, is we focus on this onboarding of a member into the ecosystem. At a second level is really the partnership with MUFG. We've co-invested with very, very deep integration levels. And then really the rest are optics, but we have a different model in terms of funds on float and how funds are returned to how interest is returned to funds, and we give more interest back to the funds, and that's partly built in our culture from serving 4-member funds predominantly. But that's really the key. Probably at a technical level, we've also invested heavily in the reduction of errors in the system, because we run a very, very lean model for our funds to lower their total cost of contact centre effort. But that's more an operational approach.
Now, I do have I think it's a statement more than a question, but it's probably worth making. I appreciate commenting on competitors is problematic, as you've just mentioned, but the current sales process for SuperChoice, if believed, indicated trade sale value of circa 600 million. If Wrkr can, over time, eat into some of their lunch, so to speak, and valuations on Wrkr approach the same, this will be a significant share price re-rate.
It would be good, wouldn't it?
I can't. It's more of a statement than a question, but someone wanted me to put it to you.
Look, it's a fair look. It's a good statement. We try not to look at. I don't disagree that we have a long-term view on driving some real growth here in the industry. I mean, for starters, we're not for sale. We have long-term aspirations in this market, and some of our areas of growth are quite different to a SuperChoice, particularly around our focus on the broader onboarding process. These are more valuable moments than moving super. You know, it's if we check a visa for someone, it's $10 a visa check, and 6 times a year at $60. That's a much higher margin ARPU contributor. So on a positive, our aspirations are perhaps more lofty. I'm not sure what drives that valuation, but I would say we are aggressive in the market, and our view right now is we are competing aggressively and expect to target and achieve that 6 to 7 million members. So read into that whatever you will as a speculator.
Why are super payments so different to normal wage payments? Why can't anyone process them?
Yeah, it's a great question, Dave. The real complexity came. What people need to understand is when the government instituted the SuperStream network, really post superannuation coming, and there being quite high degrees of fraud, no way of really tracking whether people are receiving their super. Because it's such an important and mandated payment, the government instituted the need for this network. So you have to, which is governed and funded. Actually, the governing body is funded by both industry and the ATO, but to ensure that there is a clear audit trail every time someone's super is moved into the super fund, to give them transparency. And actually, they use that information to really understand and identify fraud. One of the main reasons for Payday Super moving towards that higher alignment is, even with this complex network in place for moving money, where you have to be a highly licensed operator to move it, there are still organisations failing to pay super for employees. There's about 1.8 billion in insolvency and about 3 billion in late super that's not earning interest for employees out there. And that's Payday Super has really been designed to close those last mile loops. So it's an investment that keeps paying back for the ATO, to be honest. So they set a high standard to play.
Now, you touched on Payday Super. It is a big announcement, clearly, for your business and the Wrkr business. Is there more impact than just more transactions?
Yes. There's a couple of things that were announced, which are standout. Number one is this greater focus on compliance to the stapling rules. So that is, when you hire an individual, you are duty bound as an employer to find out what their current super fund is and give them the opportunity to connect to that. Although that regulation has been around for the last couple of years, very few organisations have had the technical ability to comply, and nor have they been focused on it. What the ATO has now said and Treasury have said is you must make that the first option. You can't offer an alternative product. That has to be the choice. And if you do, it must be what's called a choice super. So one of the My Super policies. Now, what that really does is stop a lot of disintermediation, but it leaves a gap in the market where all employers need to find a replacement solution if they've been using free software that doesn't behave or operate accordingly. That's number one. Number two is they, in a smaller set of lines in the announcement, they confirmed in 2026 they would be shutting down the ATO Small Business Clearinghouse, which is the free clearinghouse for anyone with under 19 employees. There are about 980,000, just short of 1 million employees on that platform across 240,000 small businesses in Australia, used predominantly by accountants. And all of those users need a home. They need to find one of the platforms that exist in the market and can provide to a small business. So although we're seeing growth in transactions, actually there are 240,000 small businesses that will be either looking towards their operators such as Xero or Myod, or looking for and then getting it second hand through them, or looking directly for operators such as Wrkr.
So just touching on that, is that what gives you that confidence of reaching half of the working Australian population with your technology?
Yeah, well, so we already touch 2.9, so we have an upgrade path there today. But if you take our 500,000 and if you take what we've invested in with MUFG, by default, the MUFG compliant customer base exposes to a potential of 7. You've got the those who don't go through those groups and use payroll providers. Those payroll providers are currently looking for more robust solutions that meet the new Payday Super rules, and they represent circa about another 2 million to 3 million. So our catchment pool is high, and our investment was appropriate. So that's where our current confidence comes from.
And just touching back on the point you were making about small businesses and the ATO essentially shutting off its free product, do you have a planned rollout to bring them online using the digital solution and your digital solution?
Yeah, yes, we do. We took a bit of a gamble on this, and this talks to, although it's not a large total dollar number, but we spend on R&D a little higher than some in the market. We've been investing on our ability to provide that one-stop shop is really the opportunity to provide for small businesses both the super contribution movement, the wage payment, and the single touch payroll report, all in one unique transaction. And we've been basically road testing that as well as an interface to allow accountants to log onto the system. We've been doing that for a little bit of time in readiness. The fingers were crossed a little that this announcement would happen. You've got to always be a little careful with your R&D in that way, but it's certainly played well from our perspective.
And are there any integration possibilities with accounting software providers in some of that tier 1 groups?
Yeah, so we've had we've already we had an earlier announcement, but that's really gathered some momentum. With KPMG, we partnered to do an integration of our onboarding and the superannuation allocation. with Workday. Workday is probably the fastest growing software provider in that HRM market, serving about 140 live implementations around the country. So that's progressed quite well, but it also shook out some real interest from some of the other, let's say, large American players who we're now moving down that same path with to give them that same interoperability. So we do see that high-end HRM on software and the large US payrolls have realised that, or certainly see value in partnering for that compliance moment rather than trying to build and deploy themselves here.
Question maybe for you, Karen. It was mentioned that the scope with MUFG expanded to include payroll processing. Is that function included in the $8 ARPU, or is the $8 ARPU still just processing super contributions?
Yeah, we might clarify payroll processing with MUFG is not part of that opportunity at the moment. There's opportunity to reach the employers using the Wrkr platform and to be able to push out additional Wrkr products to them, at which point they might take up, the payment of their payroll, other compliance moments, etc. So that's really where that opportunity is there. The $8 ARPU is really around our MUFG opportunity on the onboarding moments, which we've discussed, and the superannuation contributions.
So pay would be a net growth again on top. We think that's slower and will be very dependent on the two-way integration with payrolls, and they tend to have fairly lengthy development cycles. So although we're very active, we've probably, similar to John, we've not been bullish on numbers because we have to fit into somebody else's development cycle. But it does make sense at the time you pay the wage and make that final decision out of your payroll system to be making your superannuation choice now and paying it right at the same time, because they are synchronised, and paying the single touch payroll report. So we expect to see a fair bit of shifting in 2026 in that space.
You did mention that you expect to be EBITDA positive again in the next financial year. Is that realistic with large fund implementations?
It's the great debate that we have at our board right now, and we'll continue to have. Maybe a couple of things. One, we're definitely on task to meet that EBITDA positive this year. However, what is a little outside of our control is although we're targeting two more large funds in this year, we think it might be a little more work than that, and probably more simultaneous. It won't be staggered. If that's the case, it would be my view that we would invest ahead of the curve, because the sooner we bring on that SaaS revenue, it's far more value accretive for the business. So if that opportunity comes, we'd be restating, obviously, but we would be, in my view, spending upfront to make sure we bring that revenue on.
And is that the importance of the balance sheet strength?
Correct. The going out and doing the capital raise at that point was twofold. To bootstrapping your way through was fantastic, and the business has demonstrated that ability to be cautious with costs. But we are playing in the high end of town with some of the larger super funds, and there's an expectation that we're not trying to juggle costs as a priority over delivering the result in the agreed time frame. So we wanted working capital to ensure we could hold that position.
Time for the last few questions. So still coming in thick and fast. So we may need to take a couple of them offline. What happens if a super fund moves away from MUFG? Can Wrkr contract them directly or deal with them directly?
Yes, we don't have any constraints in our contract with MUFG. Obviously, we focus on the fund first. We can integrate to other platforms, so other admin platforms. So there's no reason why we couldn't move away with an organisation or indeed approach another organisation that isn't with MUFG today. In fact, ART, Australian Retirement Trust, is on their own administration platform, an American-based platform, and we integrate to that for them. So that's normal. We've tried to balance that our revenue, although we deal through MUFG and with the funds, to ensure that our revenue streams are also wide enough that we have direct contract engagement with payrolls and with employers themselves directly too.
Now, this may be a question that might be a little bit tough to answer, but the question is do we know when the current QSuper vendor agreement finishes and the probability of ART moving QSuper volume onto the Wrkr platform?
Yeah, so we've got very good visibility of the current planned projects around infrastructure upgrades and the likes, which enable it. That's what gives us confidence. I haven't seen their contract or any rollover, any extensions to it. So our understanding though would be it makes perfect sense, and they are lifting their infrastructure both for payday super readiness, obviously, but also what was always scheduled for that increased use. They're a pretty sensible organisation. They've invested very heavily in that Beam platform, so it makes sense now that it's stayed the course, and they've been focusing on some of their newer mergers, that is going to become their de facto standard.
John, a quick question for you. What factors would you be looking for to lower the beta used in your DCF?
Yeah, because I guess as Trent mentioned, fundamentally the business is not seasonal, got a bit of a compliance mode, and certainly could have a much lower beta over time. But obviously, the number one thing I'm looking for is getting those clients across. So once they're across, you've got that regular transactions, you've got the compliance mode, and you've got the customer. So it's really tracking these, and the QSuper migrations, is good, but it's really the MUFG clients coming across to Wrkr Pay that reduces that beta, and then you can start arguing what that beta should be. 1.3 is definitely too high if those clients are there. So there's the upside, I guess, in terms of that valuation.
And John, looking forward, you touched on during your presentation here, and there's a question around, you set valuation and you set some views on what you thought based on your initial initiation in 23, and then where the business got to. Now, I can't ask you to forecast too early, but do you think you'll see a similar sort of trajectory or change or step change from where you're valuing the business now to where it could be in 12 to 18 months' time?
Well, I think that beta thing is one of the things that can change. So it's sort of, once you get these clients across, there's the risk of those forecasts comes down. So that's definitely an opportunity. I think we've got a little bit in our numbers for sort of the onboarding side, but probably not as much as the benefits that could be there. And then in Hong Kong, we've only really got the one client that's migrated. We haven't got anything else. We haven't got anything in New Zealand or the UK where MUFG also operates. So, there's still a lot going on, and I think we really are still just focusing on those three key drivers that we started with, and just the timing of those. But everything else that's happened, yeah, as I said, I don't think there's a lot in the numbers for those. So that's where the change could come from.
Now, Trent, Karen, last question, and I don't want to hold you too much to a forecast, but there's a question here: pipeline of new fund contracts and timing of announcements. What does the next maybe 6-12 months look like?
Yeah, well, I'll start. Look, at the beauty, I think one of the big positives of payday super is it puts a bookend, right? The existing infrastructure for any of the current funds is not up to task, needs either fundamental change or replacement. So on that basis, July 26, the funds that we talk to want to have a solid, 12 months, 6 months minimum of clear air to be working with their customers, working with their employers around the change. So if you work backwards from that, you're sort of at a December of next year is D-Day. You need to be implemented by. So to do that, it is a 9-month implementation. We can do multiple at the same time, but you should be planning 9 months to be sensible, right? In our experience, funds don't move super fast. There's a lot of decision makers. So therefore, if I play that back, you've actually only got about 8 months at the very outset to make all of your commercial decisions, contracting, kick-off work, including having your team available. So, for our perspective, we're super busy right now on our funnel. We're expecting decisions really in this financial year around progress and direction for funds. Whether that converts to the level of detailing contracts that's needed, we're not sure, but it will certainly convert to their detailed activity and preparation. So we'll have a pretty strong view this calendar year and into the start of next year. So there's no Christmas scheduled in our shop this year.
Well, on that note, I will thank each of you for presenting today and participating in the Q&A. A lot of questions, a lot of insightful questions. So I think they're all dealt with very transparently and very openly. So I appreciate that. Thank you for your presentations, very detailed, and gave a great overview of the business. John, thanks for setting the scene. Thank you to each of the attendees for participating in such a positive way in the Q&A and throwing a stack of really good questions at everybody. So first of all, thank you to everybody.
Pleasure.
Thank you. Pleasure.
We do hope you found this webinar informative and valuable. We look forward to seeing you at our future events where we will once again dive deep into the analysis of another promising ASX-listed stock. Keep an eye on Wrkr. It's sitting at a very interesting time with a lot of news flow to come and the foundations set in a very strong way. Strong balance sheet. And as Trent mentioned, Christmas cancelled this year because it's going to be busy. So certainly a stock to watch. Thanks everyone for participating and have a great day.